getting to an exit is very, very difficult. If I just take a step back, actually, I think my genuine advice to most startup stroke founders is, particularly in the early days, people seem to start thinking and worrying and get distracted by exit far too early. And actually, it's one of those things, if you concentrate on building the brand, the business, and the financials associated with the business, wrong to say an exit takes care of itself, but the probability of you getting successful at exit will be stronger if you focus on building the business. Now, of course, as part of building the business, you need to also understand what constitutes and what represents you, giving you the best chance to get a successful exit. So that's the first thing I'd say. But
just quickly, so those principles are sort of brand, financials.
So we could have a long one on this today, but let's go through it all, because I think it's really important to understand, right? So the world has changed as well. So the first thing I'll say every time is everybody just obsesses about their P&L, which is correct, right? So everybody wants to look for strong revenue growth, and you talk about compounded annual growth rates, or CAGRs, and typically as a startup brand, you're going to want a CAGR growth over a 3-year or 5-year.
Sorry, I'm going to be a 3-year-old, so ask some really dumb questions. Say that.
Right, so this thing called CAGR, which is compounded annual growth rate.
Yep.
So all that does is that takes your growth rate, your average growth rate over whatever period of time you want to select. So it could be a 2-year, 3-year, 5-year.
Yep.
3 years probably atypical. So it will say that, look, typically, if you're growing at single digit over a 3-year compounded annual growth rate, it's probably not that attractive. But as a startup, anything between kind of late teens up to a 60% growth rate on a compounded basis excites prospective buyers. So I think the first thing to say on the P&L is obviously the revenue growth. But if you're looking at me, particularly when I invest in businesses today, the number one metric I will look at on every single prospective, kind of investment document, which they call, again, terminology, information memorandum, which is called an IM.
Yeah, I learned that the other day.
So
the
we'll do a glossary for everybody.
Yeah.
By the way, business needs to be simple. We can get onto that as well, but that's another thing. But the first thing I look at is gross margin rate, okay? Because effectively, you need to set up your value chain on your business that you're making a good gross margin. And the reason why that's so important, and just to explain what gross margin is, and again, I'll keep it simple, it's typically, and again, the big problem we have as well is that people are manipulating their definitions of gross margin rate because they're trying to hide some costs, which should be in gross margin, but they'll drop it elsewhere in the P&L. Right? Investors have wised up to that, right? There is only one definition of gross margin on a traditional food and drink business. I'll talk a little bit on D2C in a second. But effectively, gross margin is if you take your invoice price that you sell to your customer at, if you take away promotional discounts, okay, which that gives you net revenue, which then is after you take away your promotional costs, that is what you call your turnover, and that is what you report to HMRC. You take away from there your cost of goods, what it costs you to make it, plus also your logistics, what it costs you to ship it to the customer, yeah? That then gives you your gross margin. There's also something called trade investment. So for example, if you got a gondola end and paid Sainsbury's £10,000 for that gondola end, that needs to come into it. But that's what you typically call gross margin. The only slight difference is there's another thing, whether you call it gross margin 1, 2, 3, it all varies across customers, is that when you've got a e-commerce or a D2C business or a business that is a hybrid channel, you also need to look at acquisition costs for consumers there, because people can be spending between 10 to 30% of revenue getting consumers in, and that acquisition cost has to come in as well. So people need to look at that. So a lot of
people sort of they can sort of shove it under the carpet.
It'll be dropped. It'll be hidden under gross margin in something like marketing or something like that, right? And I think it's really important that there's a clean definition. But just to give you an idea, so the number one thing I look at is gross margin, right?
Yep.
And I kind of have a gold, silver, and bronze view that anything that starts with 30%, I say is bronze. Anything that starts with a 40% is silver. Anything gets towards 50%, I call gold, okay? And that's where you get excited, because the problem is that, and again, I do feel for a lot of startups, because, had a huge amount of inflation in the last few years. The majority of challenger brands have not been able to pass on the same level of inflation through to the retailers as the corporate guys, because either their brand isn't strong enough to put that inflation through to maintain the consumer demand, or else they've just not had the strength of business to be able to push it through as much as some of the corporates have with the retailers. So the reason why the gross margin is so important is that if you don't make enough money at gross margin level, you don't have enough to invest in marketing, in people, and in your overheads. And within overheads, you've got things like your processes and systems and all that. And the problem is you just continue running out of cash because, if you're turning over £10 million as a business, but you're making a 40% gross margin, you've got 4 million then to deploy on the rest of the P&L. But if you're turning over 10 million, but you're only a 20% gross margin business, you've only got 2 million then to deploy on the rest of the P&L. So you need to be making a strong gross margin business to generate cash for the business as part of the working capital cycle, but also to be able to deploy it and invest in the brand and in the business. And then the final thing, just before I kind of come off the P&L thing, is that the world has also changed when you're looking at exits. Okay, so I would say when we sold Bear, 70% or 80% of prospective buyers, we were talking about a revenue multiple as alongside an EBITDA multiple. If you go out and
just define those just quick.
I should have done that.
No, I'll be the baby here.
No, sorry. Yeah. So obviously the revenue multiple hopefully is quite explanatory. So if you're turning over 20 million and somebody is willing to pay you 2.5 times revenue, and by when I'm saying 2.5 times, typically people will take the last 12 months prevailing revenue is what the run rate is. Okay, so if you're doing a 20 million 12-month run rate, and somebody offered you 2.5 times that means effectively you'd be selling the business for 50 million. Yeah. What's happened though now is that, and it's for various reasons, it's about, people wanting to see a proper business. It's also the cost of borrowing, all stuff like that. 90% of prospective buyers will only now value a business on an EBITDA multiple because they're not prepared to buy or pay a high multiple against revenue for a business that is just hemorrhaging cash and losing money. They need to bring a business in that they feel can immediately start contributing to the wider group of what they're doing. And it's not surprising because a lot of the businesses that obviously are looking to acquire are listed, they have shareholders, they have quarterly earnings that they've got to update with, and if they're bringing something in, it's got to very quickly step up and be able to contribute to the central group. So the big change is now, and one thing I'm talking to, because I've got just under 20 businesses now that I invest in myself, right? That's my portfolio. One of the biggest messages I can give everybody is that you really need to start becoming what I call a proper business earlier than you would have done 3-5 years ago. If you want to get a successful exit, you need to think about how you can become EBITDA positive. And just to explain EBITDA, right? So EBITDA is earnings before interest, tax, amortization, okay? And that's effectively your net profit at the bottom. So once you've taken your gross margin, which we defined earlier, you take your marketing costs off, you take your people costs off, you take your overheads off, okay? That's then the EBITDA, right? And typically, again, just to give people just a benchmark, is that if I do bronze, silver, gold, I'd say bronze is 5% EBITDA and above, silver is 10% EBITDA and above, gold is 15% EBITDA and above. But the other thing that's really important, what a lot of people don't realize, is that, I can tell you now, right now in the market today, if I just talk packaged goods, the average exit multiple for a challenger brand is between 1.9 to 2.1 times revenue. And the EBITDA multiple is about 12 times, okay? It feels like we're going into like an economics lesson here, doesn't it?
Yeah.
But let me just explain why it's important. So let's just take that 20 million, which I mentioned earlier. And let's just say we're going to get 2 times revenue, which is about average, which would mean the business is worth 40 million. But let's say that 20 million business, is only making 5%, okay? So that effectively means that they're making 1 million. If you wanted to get the 40 million, but you're only making 1 million, that means you've got to get 40 times multiple on the EBITDA. It's not going to happen. People are going to look at it and go, okay, in very exception it might do for various reasons. But that's why I'm saying that you've got to almost look at the two, because let's just take that example. On that 20 million, and let's say it's 2 times revenue, which is the 40 million. At EBITDA level, if you're making, 10% EBITDA, that means you need a 20 times multiple. That becomes more realistic if you've got a really strong and hot brand.
So you said out of your portfolio of 20.
You're still awake now, by the way.
Yeah.
Apologies. I know it's worth people listening back to
thank
this.
God we're doing this. Thank God we're doing this first thing in the morning, mate. Because if this was the afternoon,
you need
double maths is when I always used to fall asleep.
You need that cortado.
Yeah. Fucking 3 of these. No, but it's super, super valuable because as even at this Houlihan Lokey is all of these, as I say, it's like exit Eldorado and this kind of opulent Park Lane Hotel, you can see that's where the end goal is. But and I suppose what I want to chat today about is how we reverse engineer what they need to focus on now. The world's changed now. It's not based off revenue multiples. We're going to be in a much more advantageous position if we go off EBITDA. How do you kind of do that? Or are some brands so far down the revenue land that they're kind of fucked?
Yeah.
You know what I mean? Put it
so I think for people starting up or in early stages, make sure you set your value chain right in the first thing. So what I mean by that is that, I see too many brands set up and go, okay, I'm only making 20% today, but I think I can get to 40%. Typically, margin only goes one way because particularly if you're dealing with the supermarkets, they want more. And as you grow, you have to kind of invest more and more, right? So I think if you're starting up today, try and set up the value chain of a business where you know straight away you can make 30, 40% margin back from whatever the consumer price, what margin you need to give the retailer down to then obviously what your cost of goods are. Try and set up a model where you know you can make 30, 40% today is the first thing to say. Yeah. For those who are slightly further down the journey, people just think it's growth, right? It's not. Be careful, it's not growth at any cost. And my advice is today is, and I've had this conversation with numerous of my involvements the last few weeks, is if you came to me today and said, look, we can have a compounded growth rate of 45%, but make 5% EBITDA over the next 3 years, or I could have 30 or 35% growth rate over the next 3 years, but make 10%, I'd want the latter. I'd rather, because 30, 35% growth is with a 10% EBITDA, in my mind today, is much stronger than a 40, 45% growth with a 5% EBITDA, because you need to rebalance the P&L, and it's really important that people, that people have a balanced P&L. And the bit that people forget as well is that if you don't have a good gross margin in the starting place, you're going to continually be fundraising. You just run out of cash the whole time.
And that's a war of attrition on the mind and the soul. For friends who've gone through that, that's where the fun sort of gets squeezed out of you.
Absolutely. But going back to advice, you said to me, look, top 3 things, right? Yeah. The number one thing that I want to explain to everybody is there's something that's more important. So when I talk about revenue, gross margin, EBITDA, let's just call that P&L stuff, right?
Yes, as we said at the beginning.
That's P&L, that's
brand,
financials.
Finance, let's go into the brand.
The number one thing is brand, okay?
Yeah.
And that's what people don't understand, right? Is that I've known businesses that on paper look absolutely exceptional because the P&Ls are unbelievable. But if anybody's going to acquire you, they will spend sometimes 6 figures, i.e. more than £100,000 on conducting audits of your business, but more importantly of your brand. So they will do brand health surveys. They will use very strong consumer marketing agencies and stuff to look at the categories you operate in and to understand how strong your brand is in those categories.
What are some of the metrics on those health?
So it will be advocacy will be in there, loyalty, will be in there. I mean, again, when you get more D2C, it's about retention, it's acquisition costs. So there's loads of different metrics, but it's basically it's kind of something called the Net Promoter Score, right?
Yep.
It's in the consumer world is, would you recommend that brand, to one of your friends to buy? People will look at that brand, and I'll give you an example. If you look at something like in coffee, for example, there's been some really good startups that have done a really good job and got to good revenue numbers. But actually, when you look at the number of exits in coffee, there's not been many. And one of the big reasons for that is people are looking at that and saying, look, I think you've done a great job, but if I look at you against the likes of Nespresso, Illy, etc., I can't ever see how you're going to play against those guys because there's such strong brands in that category.
Espresso's is sponsored by supply chain software gurus Unleashed. It talks to your e-com and accounting software. It's helped Islands cut admin time in half, get granular clarity on your margins, know where your stock is, don't miss availability. Brands like Candy Kittens, Tiny Rebel and Trip all use Unleashed, and so should you.